All right, let's jump right into it. We're going to challenge one of the biggest, oldest rules in all of investing. You know, we've all been told to diversify, right? But what if there's a limit? What if going too far, if over-diversifying, is actually the very thing that's hurting your returns?
Yeah, I know. It sounds kind of crazy, right? I mean, from the second you even think about investing, what's the one thing you hear over and over and over again? Diversify, diversify, diversify. But what if there's a tipping point? You know, a line you can cross where this supposedly safe strategy, it just stops helping, and maybe it even starts holding you back.
Of course, we all know this one. It's like investing 101. Don't put all your eggs in one basket. And it makes perfect sense. Spread your money around so that if one company takes a nosedive, your whole portfolio doesn't get wiped out. It's sensible, it's what everyone does, but is it really the whole story?
And that, right there, brings us to what we can call the diversification dilemma. We're going to dig into this exact conflict between what we've always been told is smart and the very real danger of, well, having too much of a good thing.
Okay, so let's just make sure we're all on the same page here. When we say diversification, what are we really talking about? Well, it's just this: spreading your money across different assets, different companies, different industries, you name it. The whole point is to kind of smooth out the bumps in the road. Because, you know, tech and healthcare don't always go up and down at the exact same time. So mixing them up should, in theory, give you a much more stable ride. Okay, so here's where it gets really interesting. To actually understand why diversification has a limit, you have to know a crucial secret. Not all risk is the same. In the world of investing, it really boils down to just two main types.
So first, you've got what's called unsystematic risk. Think of this as company-specific risk. You know, the risk that one company has a terrible earnings report or a new law messes up a specific industry. But here's the important part. You can actually control this. You can get rid of most of it just by owning a handful of different stocks. Then, you have systematic risk. This is the big one. It's the risk of the whole market going down. Think recessions, global pandemics, that kind of thing. It hits pretty much everything, and here's the kicker. You can't diversify this away. It's just part of being in the market. And believe me, understanding this difference is absolutely key.
So if diversification really only helps with that first kind of risk, the company-specific stuff, that begs a pretty big question, right? How much diversification do you actually need? Well, you might be surprised to hear that decades of research point to a very specific number. We'll call it the 20-stock sweet spot.
So let's start with a baseline. Imagine you put all your money into just one single average stock. According to some of the foundational research in this field, your portfolio's risk level, its standard deviation, is a massive 49.2%. To put it simply, that is an incredibly bumpy, super volatile ride. You're in for a wild one.
Okay, now watch this, because this is where the magic happens. Look at what happens to that risk when you go from just one stock to 20. It plummets. It gets cut by more than half, all the way down to about 21.7%, a huge drop. But now look what happens when you keep going. When you go from 20 stocks all the way to 1,000 stocks, the risk barely moves. It only drops a tiny bit more to 19.2%. This is the law of diminishing returns in action, crystal clear.
Let's just put some hard numbers on that to really let it sink in. The first 20 stocks, they do all the heavy lifting. They slash your risk by a huge 27.5%. But the next 980 stocks you add, all that effort only gets you another measly 2.5% of risk reduction. The takeaway here is massive. After about 20 well-chosen stocks, you've pretty much gotten all the risk reduction benefit you're ever going to get from diversification. So, if adding more stocks past that 20-ish number doesn't really lower your risk, what does it do? Well, it can walk you right into something called the over-diversification trap. And trust me, it has its own unique set of problems.
And the downsides are pretty major. For one, if you own, say, 300 stocks, and one of them is an absolute home run, it doubles or triples, guess what? It barely moves the needle in your total portfolio. Its impact is just tiny. Your potential for big returns gets watered down, and your performance starts to hug the market index. You essentially become the average. This is a huge issue for many mutual funds. They own so many stocks they basically are the market, but they charge you high fees for the privilege. At that point, you might as well just buy a super cheap index fund and call it a day.
So, what's the solution here? What's the takeaway? It's all about investing smarter, not just wider. It's about being strategic. not just collecting stocks like baseball cards.
Here's a great way to think about it. Diversification, it's kind of like ice cream. A little bit is absolutely fantastic, it's great, but too much? Well, too much just cancels out all the good and leaves you worse off.
And you don't have to take my word for it. Just listen to the man himself, Warren Buffett. He said, "Why diversification is only required when investors do not understand what they are doing." Wow. I mean, his point is crystal clear. If you've actually done your research and you believe in the companies you own, you don't need hundreds of them. Owning a little bit of everything can actually be a sign that you're not confident in anything.
So here it is, the big takeaway. The goal isn't just to own 20 stocks. The goal is to own a focused, balanced portfolio of around 20 uncorrelated stocks. And that word uncorrelated is so important. It just means you want to own businesses that don't all zig and zag at the exact same time. You want a mix of different sectors. Some tech, some healthcare, some financials. That is real, effective diversification.
So, this really just leaves one final question for you to think about with your own money. Is your portfolio truly diversified, or has it been divorcified? Are you set up to lower your risk while still having a shot at great returns, or have you accidentally diluted your portfolio so much that you're pretty much guaranteed to just get average results? Something to think about. Thanks for tuning in.